So today, we're going to pull back the curtain on the world of online trading. We're using Kizzi and Klocha's fantastic guide for beginners as our roadmap. We'll get into what it is, how it actually works, and, those crucial first steps you need to know about. Ready? Let's get into it.
I mean, you've probably asked yourself this, right? You see the headlines, you hear people talking about it, but how does someone go from just sitting on their couch to actually participating in these huge global financial markets? Well, that's the journey we're about to start. The short answer? It all comes down to technology. The internet basically blew the doors off the old-school exclusive stock exchange floors. It put the power of the market, quite literally, into the hands of anyone with an internet connection. And just like that, a whole new generation of home traders was born.
So, what are we really talking about here? At its heart, online trading is just buying and selling stuff, stocks, currencies, things like that, using an online platform. Instead of having to call up a broker on the phone like in the old days, you are the one clicking the buttons, making the trades yourself, in real time, right from your own screen.
Okay, and this really gets to the heart of it. On the one hand, the upsides are huge. You can do it from anywhere, the costs are way lower, and you're in the driver's seat. But, and this is a big but, the downsides are just as real. The markets can be incredibly volatile. That easy access can sometimes lead to making impulsive, emotional trades, and you really do need some knowledge to know what you're doing. It's that classic trade-off, high accessibility meets high risk.
All right, so you get the pros, you see the cons, and you're thinking, okay, I'm ready to take the first step. So where do you begin? Well, it all starts with setting up your account. And honestly, it's a pretty simple three-step process. First, you've got to choose a broker. Think of them as the company that provides you with the tools and the access to the market. Second, you open your account with them, which is usually just filling out an online application. And third, you fund it. You deposit the money you're planning to trade with. But wait, how do you pick the right broker? This is a really important decision. You want to look for a few key things. You want low fees so they don't eat away at your money. You need a platform that's actually easy to use and doesn't crash on you. It's a huge plus if they offer educational resources. And of course, security has to be top-notch. You need to know your money and your data are safe.
Okay, your account is set up and ready to go. Now for the fun part, deciding where you actually want to trade. Think of it like looking at a world map, but instead of countries, you're seeing all these different financial landscapes, and each one has its own unique terrain.
Now, the most familiar territory for most of us is probably the stock market. When you buy a stock, you're literally buying a tiny piece of a public company. Think Apple or Google or Ford, and you're hoping the value of that piece goes up over time.
Then you have what some people call the wild frontier cryptocurrency. This is where you're buying and selling digital assets like Bitcoin or Ethereum. These are a whole different beast, operating on a decentralized technology called the blockchain.
And this is the key thing to understand about crypto. It's a market that's famous for its extreme volatility. I mean, prices can just skyrocket or totally plummet in a really short amount of time. And that's the double-edged sword, right? That volatility is what creates the chance for massive returns, but it also means the risk of losing is just as high.
Next up, we have forex. That stands for the foreign exchange market. And this is the single biggest financial market on the entire planet. It's where all the world's currencies get traded.
See, in forex, you're not just buying one currency. You're always trading them in pairs. So, for example, you might be trading the euro versus the US dollar, and you're essentially betting on which one is going to get stronger. And because it's a global market with different time zones, it's open for business 24 hours a day, 5 days a week.
And the trading world doesn't even stop there. You can also trade commodities. We're talking physical things like gold, oil, even coffee. Or you could get into bonds, which is basically where you're loaning money to a government or a big corporation, and they pay you back with interest.
So, you've picked a market, you think you spotted an opportunity. Now what? How do you actually, do the trade? Let's talk about the essential tools of the trade, your orders and your analysis. See, you don't just hit a button that says trade. You have to give specific instructions, and we call those orders. A market order is like shouting, "Get me in now, I don't care about the exact price." A limit order is more precise. It says, "Hey, I only want to buy or sell if you can get me this specific price or an even better one." And a stop order is like a trigger. It just sits there until a certain price is hit, and then it turns into a market order.
Now, let's zoom in on one of these, because it's probably the most important one for any beginner. It's called the stop loss. Think of it as your automatic safety net. You set it at a price below where you bought in, and if the trade goes against you and hits that price, your broker automatically sells for you. This is your #1 tool for limiting how much you can lose. It's absolutely crucial.
Okay, so how do you even decide when to buy or sell? Well, there are two main schools of thought here. Fundamental analysis is kind of like being a detective. You're digging into a company's financial health, its earnings, the news, the economy, all to figure out what it's truly worth. On the other side, you have technical analysis. This is more like being a weather forecaster, studying past price charts and patterns to try and predict where the price might go next.
And you can see the difference pretty clearly here. On the left, you've got the fundamental analyst, buried in financial reports and data. And on the right, you've got the technical analyst, staring at charts, looking for those telltale patterns. The truth is, a lot of successful traders actually find a way to use a little bit of both.
All right, we've covered the what, the where, and the how. But honestly, the most important part of this whole journey is learning how to navigate it smartly. And that really boils down to two things: having a strategy and managing your risk.
Look, successful trading is never random. It's not gambling. It requires a plan. You have to ask yourself, what are my goals here? What's my style going to be? Am I trying to get in and out of trades really fast, which is day trading, or hold them for a few days or weeks, which we call swing trading? And most importantly, how are you going to manage your risk? A very common rule of thumb is to never risk more than, say, 1 or 2% of your entire account on any single trade.
And that leads us to this huge concept called position sizing. This is all about deciding how much money to put into a single trade. It's not about winning every time. Nobody does. It's about making sure that when you're wrong, your losses are small, and when you're right, your winners have room to grow. This skill right here is what separates amateurs from pros. And if you take just one single thing away from all of this, please let it be this: protecting the money you have is job #1. Before you can even dream about making a profit, you have to get really good at not losing your capital. Managing your risk is the foundation that your entire trading journey will be built on.
So there you have it. We've laid out the map to the world of online trading, from setting up your account to picking a market to managing your risk. The knowledge is now in your court. So the real final question isn't for me, it's for you. Your trading journey begins now. What's your first step?